Hello everybody and welcome back to another video. So in this video I'm going to be going over why I think Bed Bath & Beyond stock is brutally undervalued and why I am buying it. Just a disclosure here that earlier today, at least when I'm filming this, which is Thursday, I bought $800 worth of Bed Bath & Beyond shares, about 40 shares. So just a disclosure there, so you guys know. So first, on the valuation, their market cap is about $2.5 billion. In the recent quarter, their revenue was about $2.7 billion. This means that if they have literally no growth into next year, which I really doubt, which means that their forward price to sales ratio or next year's valuation of the company versus its sales will be only 0.25, which means that 3 months of Bed Bath & Beyond sales account for its entire market cap, like the entire valuation of the company, which is really crazy. I mean, that's incredibly low. Like, that's the sort of valuation that a company like Ford would have that is just in complete and utter structural decline and just kind of going extinct, you know? It has such a low forward price to sales. But the difference between Bed Bath & Beyond and Ford is that Bed Bath & Beyond, for one, is entirely restructuring their business, which I'm going to go over in the next slide, and that they're actually relatively profitable. Like, if they have the same profit that they did in the last quarter, $217 million, for the next 4 quarters, they're going to have a forward PE of only about 2.5, which means that 2.5 years or 3 years or so of the profits will account for the entire value of the business, which is incredibly low because the average PE for a company in the S&P 500 these days is like between 25 and 30, not 2.5. So it is, in my opinion, drastically undervalued on both the profit side of things and the sales side of things. Now onto the business model improvements. For one, they're analyzing how customers shop and which sales, like discounts, make sense and which don't. And they're just generally what they're doing right now is they're running a lot of statistics on like what customers like to buy and what discounts work with customers, which discounts don't work, which means that they could optimize their business to have the highest profits. For two, they're selling off all their businesses that aren't profitable, which is giving them more cash to grow or pay off debt, and of course making them more profitable since they're selling off unprofitable businesses, of course. And number three, they're growing their online store, which was practically non-existent before. Well, not entirely non-existent, but I mean, it was a much smaller part of their business, and they're growing that, so that's definitely a pretty big growth factor for them. In the next, who knows, couple years, maybe more. I bet that online store is going to be really crucial to their business. Now, the risks with the company is that they have high debt that they accumulated over the last couple years because in the last couple of years they've been in structural decline, but now they're kind of getting out of that structural decline. They're having a revival because they're restructuring their business, and right now they have about 3 or 4 times more debt than they do have cash, which is definitely not great, but it's not exactly such a terrible balance sheet either. I mean, it's not horrendous. Like, I don't think they have any default risks anytime soon or bankruptcy risks or anything like that. But again, that's just my opinion.
Another thing about this company is that it's not a super duper high growth company. It's not like Tesla, which this year recently has been growing like 40% quarter over quarter in terms of revenue. Like, this is not that type of company, all right? This company is not going to be growing 40% quarter over quarter. But I think it's going to grow pretty decently as they optimize their business model, and because their online store is growing very rapidly. I think it's had like 100% growth in the last quarter or something, their online business. So I think you could expect at least 5% revenue growth year over year, and I think 15% is possible, definitely possible, if they have a very good year. So I guess that's just something to consider. My price target for this company over the next 2-3 years, I would say, is around $100 a share, because I think the company is very undervalued, and I think people are going to see the value of it more and more as the sort of restructuring finishes, because when the restructuring finishes, their business model is going to be very optimized, and they're going to be more diversified away from their crappy, declining store business, right? So I think people are going to start seeing the value in this stock sooner or later. I mean, people already are starting to see some value in the stock, which is why you have seen it go up so much recently, but it's still not nearly valued like it's supposed to be. So I think $100 a share is not too crazy to maybe expect in the next couple years. But again, that's just my opinion. It's not advice or anything. So you should definitely do your own research before buying this stock. Don't just listen to me, a 14-year-old kid, alright, people? But anyways, if you guys did enjoy this video, I would love it if you guys left a like on this video, subscribe to my YouTube channel, and you can comment down if you like this video or not, or which videos you'd like to see next, because I do take your guys' suggestions into consideration for sure, especially because this is such a small channel, right? But anyways, see you guys later. Peace.